for those of you who do not know me and have not been on one of these live streams, my name is Janae Ortiz. I am the founder of REI Social. It is a turnkey, ready to publish social media system for real estate investors. Basically, if you can copy and paste, you can have an amazing social media presence. And that's what I do, because investors simply don't have the time to become social media experts themselves. But we all need marketing because it is absolutely the lifeblood of our business. If you don't have marketing, you don't have leads. Without leads, you don't have deals. And without deals, you're not retiring early, which is the dream, right? Today, I have with me Brenda Mas, and I'm so excited for her to be here. She has 20 years of experience professionally managing multifamily portfolios for wealthy family offices. And that experience includes everything from existing student housing, Class A, B, and C products, plus development of ground-up high-rise and mid-rise apartment buildings throughout Los Angeles. Now she uses her experience to syndicate Class B, C, and ground-up development deals in California and Texas. And her partner is her husband, David, who is also on. He is a construction expert and has built over 10,000 apartment units for some of the largest REITs and family offices in the US. So the two of them have tremendous experience around this topic of syndication. And I'm just really pleased and amazed that we have such talent inside of our membership. So Brenda, without further ado, I'm just going to kind of pass it over to you because I believe we've got everybody here and they'll roll in as they do.
Well, thank you honestly for having me here. I'm honored to be here and just share what I've been able to grasp over the last few decades. Really, you go into your career and you never really understand how you can impact people. And now we're at a time where I feel that, there's so much uncertainty and people want to know where or what they can do for them to still be able to retire someday and be able to live a comfortable life. So for me to be here today and be able to share that knowledge, honestly, it's an honor. And I hope it impacts others and, they find nuggets in here that can help them along their journey. So thank you. And I'm going to share my screen. And just so you all know, I made it a little fun. I feel like people in real estate tend to make things a little bit too serious sometimes. And I know with the economy and everything that's happening now with the news, it's been so dreadful the last few days. So I wanted to make it a little fun and, hopefully keep your attention through this because it can get dense at times. But, there's no questions. That's a dumb question. So at the end, please feel free to ask any questions you have. I'm here. I'm an open book and I'm just here to help. So we're going to start. So syndication fundamentals. So how to get started in apartment investing. So this is the agenda. Today, we're going to discuss, why real estate. There's so many options for you and what you can invest in. And so I will give you a rundown on what makes real estate investing, obviously a great option comparison to say like stocks or crypto. I'm going to also get into apartment investing in particular here and why that is an option that many people look into, especially as they start earning a lot more money. And it becomes something viable for them to do. What is a syndication? That term is thrown out there, but sometimes it's a little vague. People don't really understand what that means. So I want to clarify that for you and let you know that this is something you can invest in. Most people do know JVs, but I want to really tell you what is the difference between a JV, what's the difference between a syndication. And as a newbie investor, sometimes syndication is actually the best way for you to go. And we'll go into how to find an investment. And lastly, we'll talk, just have an open conversation. What are your questions? I'm here to answer them. So before we get started, I must share a disclaimer with you all. Obviously, I'm not a tax professional. I'm not an attorney. So everything I say is just based on my opinion, my experiences. So please do not take what I say and run with it and make your own investment decisions, always speak to a professional about these things. So just putting that out there. Again, a little bit about me. She already went into it, but from an investor perspective, just so you all know, I have managed over 1,000 doors, over multiple portfolios, and currently, I'm invested in over 1,000 doors, and it's growing. I did earn my master's in business analytics at LMU, so that really helps with the data side and the analysis side of trying to understand, the numbers and figuring out where's the market going, what are the trends. That's really been helpful for me. So here's some of the projects, a little moment to brag. Just giving you an idea of some of the projects that I've worked on. In the middle, we have, high-rise development, 3-phase, 689 units in downtown LA, 9th and Figueroa. For those of you in LA, you would know where this is. The bottom two are also in downtown LA. We have a 218 unit on the left side and a 700 unit in the bottom right. Those, I worked on entitlement, subdivision, the entire design process, all the way through stabilization and getting those into permanent financing. So white real estate. Right now, as you know, we've been dealing with a lot of uncertainty in the market. Just this week, crypto is getting hammered. It's down 30% alone in this week. And there's a lot of market analysts who are saying this is the deepest and darkest phase that crypto has gone through. It's going through a meltdown. People really don't know where it's going to go. It's been something that I've seen a lot of people really just speculate, jump into. They really thought that crypto is going to be something that, where the entire financial system is going to direct itself into crypto. There's really no oversight right now. And we're just seeing how this is unraveling. And I think a lot of people are finding that it's not something that they can rely on in the future. So unfortunately, there are a lot of individuals who put in a ton of money into crypto and they're really hurting right now. So hopefully they can ride that wave a little bit longer, but I don't see how it's going to get any better at this point. So unfortunately, this is one of the investments that once you lose your money, it's gone, right? There's really no way to recoup it at this point unless you wait it out. Same thing with the stock market. So although it's a little bit safer and people have told you, hey, put your money in a mutual fund, you have a 401k, you have an IRA account, you put it in there really thinking that that's what you're going to retire on. You're going to bank on this money. But as you're seeing today, the stock market is tumbling. It's down 21% alone just this year. And what does that mean? That means there's people that are going to have to delay their retirement, unfortunately. And the IRS, they give you these tax breaks. But why do they give you these tax breaks? They give them to you so that you keep your money in these type of investments, right? Because the minute you take it out, say you need emergency funds, you want to borrow money, right? You have to borrow your own money to use from your 401k. What do? They penalize you if you don't return it. So that's the IRS's way of really making you continue to keep your money in the stock market. And unfortunately, once it's down, same thing as crypto, it's very difficult to see it rise. And so you have to wait it out, buy low. They give you all this advice, but again, in the stock market, even if you earn some gains, you're going to pay taxes on that in the future, right? So that's, something that as a real estate investor, that's not really an option for me. It's something that just like crypto, I put in some money, but it's not what I rely on for my retirement or to build my wealth. And lastly, we have real estate. So even though the real estate market has been great, we're dealing now with this inflation issue, and the Fed is really trying their hardest to correct this issue. And what they're doing is they're increasing interest rates. That's the only way they can slow down the economy is, hey, let's put the brakes on this inflation issue. Prices are getting out of control. How can we get people to stop spending money? Meaning trying to reduce that demand, right? Because there's such high demand, low supply. So what does that do? That drives prices up of all the products you're trying to buy. And the Fed's only way that they see viable to be able to bring the economy back into maybe a normal state, which I think they're very late at getting to this issue, obviously, is to raise those interest rates. And so what that means is that for normal people like you and I, if we want to go borrow money even for a single family home, it's going to be a lot more expensive. So that's also pushing some of these real estate investors that go into single family out of the market slowly, right? So we're seeing that the market is going to go through a correction. There's going to be a slowdown period. Not a lot of people can buy real estate when the interest rates are that high, at least psychologically, even though interest rates are, 5-6%, that's still relatively low than it was, a few years ago. But still, psychologically, that's a big ding in our pocket right now compared to what it was maybe a year ago or even a few months ago. But what's great about real estate right now is that we're seeing some positive indicators, and that's what's keeping real estate really afloat. And going forward may create some really strong opportunities here, especially for those invested in apartments. And that's because we have record rental rates. They're just rising. People, for example, I'm in Texas right now, I'm in Dallas. And here, just the rents alone went up 18% since the beginning of the year. That's insane for an apartment investor. It's hard for the tenants, right? Additionally, we have a shortage in housing across the country. There's just not enough being built. Even if they started construction across the nation right now, it will not meet the demand. We're just really behind in how much housing we need for our population growth. So I'd like to start with, this quote here from Andrew Carnegie, which is 90% of all millionaires become so through owning real estate. To me, when I saw this, I believe it was like early college, that stuck with me. It's very important to remind yourself, if I really want to become wealthy, if I want to have, some freedom, hey, why not do it through real estate, right? And around the quote, I put different items here that speak to why real estate is, a really great investment. Obviously, you get your time back. It's a much more stable investment. It appreciates over time. It's an inflation hedge. So like right now, even though we're experiencing inflation, well, guess what? The rents in our investments are going up. Obviously, you get cash flow. Some of that money goes right back into your pocket every month. And where else but in real estate can you get 100% of appreciation for only a down payment? Not very many places, actually nowhere else. So I would say that, real estate is just a great investment. So now let me speak to you about what's happening in the apartment investment side as of today. Hard assets are just something that for me is something that makes me feel comfortable investing in, right? It's something I can touch, I can feel, I can drive by and make sure it's still standing there, right? It's not a stock. It's not a crypto that I'll never touch, feel. And it's honestly hard for it to lose its value over time. Today, because of inflation, because of those rising interest rates, it's a great wealth preservation type of investment. You can put your money in, and honestly, you're probably losing it otherwise, because with inflation up, I think it's 40% higher, or the highest in 40 years, I think it is. You're losing money every day. You're paying it in everyday normal things. So having money in real estate where it's an asset, it's growing, it's a great way to preserve your wealth. Obviously, you get tax benefits. You can depreciate a building, right? You can take the components. That's what a depreciation is. You take the components of a building, and then you can write those off over a time period. And hedging, just like I mentioned, over inflation, it's income generating. You're getting cash flow. And lastly, the last few years, investing in apartments has become a lot more accessible to the normal everyday person via syndication. I think several years ago, a lot of people were not able to invest in syndication because they just didn't know how. They didn't know where they can find these type of investments. Now it's becoming a lot more easier. So this is why apartment investing is really important right now. Like I mentioned, there's a housing shortage across the nation, the highest it's been in a very long time. If you look at the dark blue line here, that alone is the supply, right? The lighter blue is the pricing. So you can see in 08, 09, which was the last crash we had, well, guess what? Prices went down and supply went up. What we're seeing now is that it's inverting the opposite direction, where supply is very limited. And because of that, housing prices have gone up, which we've all experienced right now. And there's just too much of a demand to meet what the supply is available at the moment. Affordability, unfortunately, our country is going through a very difficult time where people just cannot afford to buy a home. And you can see, 2008 crash, it spiked, right? But now affordability has decreased to negative 29%. So that's a very, very staggering number there. And what that means is that that's going to push more people into apartments, right? They can't buy a home. They're going to have to stay as tenants much longer. And of course, like I mentioned, because of that, we have a really strong rental market. So with inflation up, that's really driven those rents high. And with the federal rates, going up, that's not only going to slow down the residential market, but there's going to be some volatility we're going to start to see in the market. So, it's going to be a very interesting few months coming up. But in the long term, the indicators are there that it's a great time to invest in apartments because we do have the supply constraints. And also we have very limit in, we have a labor shortage. We really do. So what that means is like, we can't get skilled labor workers to build these buildings. And I know some of my husband and his coworkers and, fellow executives are here and they can attest to that, is that there is a lot of shortage in labor and especially skilled labor. So we just can't build them fast enough. And that graph on the right, it just shows you, how much rent is going up in these various metropolitan areas. It's spiking. So that's unfortunately really good for apartment investing. So what is a syndication? Let's just get to it. This is where a group of people, all of you here, can pull your funds together. You'll become limited partners and we'll have this capital and we'll go and we'll purchase an asset. It doesn't have to be an apartment building. It can be self-storage. It can be almost anything, but it's the act of pooling funds, capital together to buy a large asset. And I say large because that's the whole purpose of pooling money together, right? It's because you're able to now go get an asset that you probably would not be able to purchase on your own. So now with the pooling of these funds, you're able to go for these larger apartment buildings and you utilize the talent of someone that's experienced, say like myself. I'm a general partner. And with my experience, I can go and oversee how the investment is run. So you as a limited partner, you're a passive investor. I handle all the work, all the headaches, and you as a passive investor, you get to collect your, passive distribution every quarter. And I do all the work for you. And that's how a syndication works. So there are two types of investors, as I just mentioned. General partner, that's who I am. We're the sponsors, we're active. That's the most important thing, is I'm an active investor. I'm dealing with the day-to-day operations of how the investment is going. And obviously this person has to have some experience. So you are making those decisions every day. You're also carrying the burden of the stress of making sure that everything is going well. And you as a limited partner, you're a passive investor. You don't need to make those day-to-day decisions. You don't need to have that experience. That's why this is really a good tool for beginning investors. And as a limited partner, you must meet, or you do fall into one of the two different types of investors, right? So there's accredited investors and then there's sophisticated investors. And I know this is where it gets a little dense, but an accredited investor has more options available to them. Why? Because they have the net worth which has to be at least $1 million. They have an income of at least 200,000 or 300,000 a year if it's a couple. If you don't meet the criteria of an accredited investor, then you are considered a sophisticated investor. This is someone who would have adequate knowledge about how real estate investing happens, right? Some finance, some business. And by investing, you are basically agreeing that you can evaluate some of these deal risks, right? So if you don't fall into an accredited investor, then you might become a sophisticated investor. And this is important because, like I mentioned, as an accredited investor, you have more opportunities. And that is because the investments that are available to the public, meaning they're allowed to advertise, those are the ones you might see on Facebook, you might see on a website, right? You get those ads targeted at you. You can invest in those because the SEC oversees syndications, or they have some securities laws that you must meet. So for those investments that are actually advertised to the public, those are considered 506Cs, and those only accredited investors are allowed to invest in those. And that's why I say you have more opportunities, right? So here you can invest, in limited number. They are always targeted to you, no problem. But if you're not an accredited investor, if you're a sophisticated investor, then you must meet, or know the sponsor, right? So this is like the friends and family deals. This is the person like, I know you, so now I can bring you into my deal. That means I'm not allowed to advertise because I can't go out to the general public and say, hey, come invest in my deal. So for someone like me who does these 506B deals, it really only goes to people that I know. And so I can advertise, like I mentioned, but I can also take in accredited and sophisticated investors. And so that really opens it up to newbie investors. If you know someone who is a sponsor, to be able to, understand and open up that conversation, you must have a relationship with that sponsor. And so that allows you to get to know them. It also, in the SEC's eyes, they see it like, well, they know that person, so they trust that person. So even if they are not an accredited investor, whom the SEC thinks, hey, if they lose their money, they're fine because, they're high net worth. But that allows the SEC to say, well, at least they knew the sponsor they invested in. They were able to reach out to them, have that conversation, feel comfortable with that deal to be able to invest in their deal. So now we'll get into why syndications, right? So here is where it gets a little interesting. If you are looking, you have some money, you want to invest, and you're saying, but it's not going to grow that fast. I can't go do these big deals. Well, with syndication, you can, right? Like I mentioned, we can go for the larger assets. We can go for these bigger apartment deals. And you still put in some money, but you own a bigger piece or a piece of a bigger asset, right? And also you're leveraging my experience. You don't have to know how to run financials, how to, negotiate loan documents, how to, put everything together. You don't need to know any of that. You're leveraging my experience now to be able to own a piece of these investments. And of course, you still take advantage of those tax benefits. So even though you're not doing the day-to-day work, you are still getting those tax benefits for your investment. Second, it's a passive investment. You don't need to do anything. You don't deal with tenants. You don't deal with toilets. Minimal time, if any, is just spent in making sure that you read, the monthly newsletter that we send out with an update and take a look at the financials. And if you have questions, ask your sponsor. So that's the limited amount of time. You don't need to deal with any of the other headaches. The risk here is also spread, meaning because it's pooled funds, you are not really at risk of losing a ton of money, right? Like everybody put in all their funds to buy this investment. And because these commercial properties, they're considered commercial loans, right? Because they're apartments fall under commercial properties, they get non-recourse loans. So what is a non-recourse loan? It basically means that the owners, the investors, we're not liable for that loan, right? The bank runs it based off of the income and that asset alone, which is great. In your single family home, if you own a home, obviously you have a recourse loan. The bank will come after you and will, foreclose, and it'll stay on your credit. It'll remain in your history. You have to pay it back. Here, you don't. Okay. It's limited risk, obviously, to the limited partners. The GPs, us as the general partners, we sign on that loan. So we still have to deal with what are called bad boy carve outs, meaning we have to act appropriately or they can come after us, right? But you don't need to do that. And of course, there's securities laws that prohibit us from doing certain things that we're not allowed to do. And we have to stick by them to have that exemption according to, how they want us to operate. But this is definitely not an investment for you if you are the kind of person who needs that control, who needs to have a say in the day-to-day and how things are being operated. This is not also for you if you need to be liquid. Say, hey, if my car breaks down tomorrow, I need to get my money back. This is not that type of investment. These are long-term investments. Once your money is in, it's in. And that's not, you can't just take it out, okay? So how does it compare to a JV, right? So most people hear of JVs like, hey, I don't want to own a small percentage of a big deal. I want to own a building. I want to own it for myself. I want to have maybe my uncle and my brother, and we want to own an apartment deal together. That's what a JV is, right? It's limited. There's not a big pool of funds. While here, what they state is that if it's not a syndication and you're going to be a JV, right? How do you compare them? Well, in a JV, every single owner must be an active owner. You can't have someone who says, take my money and I'm going on vacation. You do all the work. It doesn't work that way. That would make it technically a syndication. So here, every single member must have an active role. So sometimes that may mean that, you know what, I'm not going to go JV with someone who doesn't have any experience in doing anything, right? So it might be harder for you to find partners or be a partner if you don't have some sort of experience, something to bring to the table, right? And obviously it's a time commitment. You have to put in the time. You have to deal with the tenants, the toilets, the issues that come up with it. Obviously you're exposed, you're risking, you're putting yourself, into these exposure issues where you're signing off on the loans. And my experience, because I've dealt with these family offices that are all JVs, there were a lot of capital calls. And so what that means, if you don't know what a capital call is, it means that when the buildings are starting to not have enough funds, they put out a call to all the members and say, hey guys, bring your money in. We need to make this a viable investment again. I need $25,000 by Friday. And you have to do it. You have to put in your portion. Okay. And the reason for that is because most of these JVs, people hold them for a very long time. So they're constantly recapitalizing. Okay. And like I mentioned, they're smaller deals, right? So scaling, growing is a lot slower than it would be in like syndication. And because they're smaller, you're not spreading out the costs across the table. It's, your fixed cost is being spread amongst a smaller number of units versus larger. Okay. Also, it's a legacy asset. That's what is great about JVs, right? You can keep it, your kids can inherit it, you can pass it down. The exit plan, like I mentioned, can be a much longer time period versus syndications are like 3 to 5 year holds typically. Legacy assets can be 10 years. They can be forever. Some of the ones I dealt with were like 20 years. So you can keep these forever as long as they're cash flowing. Okay. Partnership driven. Obviously, if you don't like the people you partner with, that's very difficult in a JV. You're in it for a very long time, right? Not saying that it doesn't happen in syndications, it does, but at least the time period is a lot shorter, 3 to 5 years, and you hope that the main sponsor is there's someone with a moral compass that will make sure that the deal still runs properly. But when you're in a JV partnership, that's a 10-year hold with a fixed rate, or a fixed loan for like 10 years, that's a very long time to deal with people you're miserable with. It's difficult. And of course, it's appreciation driven. So what does that mean? Is because you hold them for a long time, and this is just my personal experience, you wait and you hope that they go up, right? They go up in value so that you can refi, take some cash out and distribute it, or go buy another apartment building. So you have to wait it out. And they just kind of keep repeating this cycle. So in a way, that's really great because you can cash out, refi, go buy another building, but it'll take a while to do that, okay? So next steps, say you are interested in syndication, right? That sounds like it's a great opportunity for you. My advice, find good sponsors, okay? It's so important you find people who are experienced, who know what they're doing, especially in this market now with so much uncertainty. I don't have a crystal ball. I can't say what's going to happen in the market the next few years. But what we do know is that the Fed just raised the rates, 75 basis points yesterday. They were saying it was going to be 50. It was 75. And they're saying they're going to continue to do so until we can get, the economy back in order. So my advice is that's going to show a lot how stable some of these investment deals were put together from the very beginning. So it's so important at this time to find those sponsors who are experienced and who, most importantly, are aligned with your ideals. And what I mean by that is that person going to be willing to do everything it takes to make sure that things operate properly? Okay, so, and I put that little icon there of the arrow going up with a balloon because it's just so symbolic of so many things that are happening in the market right now, right? Like inflation is just out of control. We have no idea where it's going to end, but also the market, real estate market has been hot. It has been, in my opinion, out of control. And what that means is, and we saw it in 2007, 2008, that there's a lot of people who flooded this market thinking that they can operate and do certain things. And they've been taking people's life savings. It's life savings, right? This is your investment, and running with it. And in my opinion, this is a very important time for you to vet those people, because we're going to see some deals come back into the market where we didn't have experienced sponsors, and they took their money of investors, maybe some family and friends mostly, and they said, hey, you know what? I ran a successful business, XYZ, in this industry. There's no way I can't do it in real estate. Well, my analogy is, just because I've driven a car doesn't mean that I can fly a plane. So in my opinion, make sure that you find good sponsors that know what they're doing, that when you speak to them, hold the same ideals as you do, okay? Next item is vet the deal. It's been a hot market, like I said, super hot market. That means that people have been overpaying, just like in single family homes. You have seen it. People are overpaying, overbidding. That's no different in apartments. Some people have overpaid, overbuilt, and their numbers are not going to make sense. So make sure that the deals that you do invest in have good fundamentals, okay? And lastly, just be ready. Once you're ready to invest, there's so much paperwork. Don't be freaked out by it. It's required by the SEC. There must be so many documents that you sign, letting you know this is how your investment works. It needs to be put in writing. You are fully aware, it's transparent. And it also is a great document for the sponsors like myself to hold me accountable, to make sure that I knew and I disclosed to you what my plan is, and I hold myself to it. So now back to a little plug about myself and my husband and our company, Bestwell Ventures. We have two ideals here of what we do. We take existing buildings. For us, they must be B or C class. We don't invest in A class. And I can get into that if someone is interested. But our experience is developing A class. So, I have some thoughts on why we don't invest in A class. Also, the regions we invest in, they must have strong population growth. They must have strong job growth, and they must be landlord friendly. So when it comes to existing buildings, we don't invest in California, right? In California, it's very tenant friendly. And for existing opportunities, we are open to accredited and sophisticated investors because it's a friends and family deal. Now, when it comes to the development and construction, Here, we look into more less restrictive zoning areas where there's affordable land costs so that we can build at an affordable cost, but there also must be strong job and population growth. Now, this one, because development and construction takes a much longer time period, we want accredited investors. And that's just because we want to make sure that they are fully aware of the process, and it's just a much riskier investment than it is, for an existing. And that's really what I have today. So thank you so much for having me. And of course, I'm here. If there's any questions anybody has, I'm here to answer them. And reach out to me, my email, my website. You can go to my website, add yourself in the contact info if you want to be informed of any future deals that we do. And also just to learn about us and what we do. I'm happy to connect with any of you and answer questions at any time.
All right, you guys, thank you so much for your time tonight. I really appreciate you, Brenda, and all the time that you spent putting this information together and then coming on here tonight. I hope that we can have you here with us again, and maybe you can drop some more knowledge bombs on us. I hope to see you guys on another live stream very soon. Thank you, Brenda.